Good afternoon and welcome to another Citro Saturday or noon class for Quest Trust Company. Thank you so much for joining us. We are so happy to have you. Today we have a very special guest, Mr. Vincent Celeste. He is going to be talking to us about the changing economy and multifamily syndications. We are so happy to have him. But just before that, we are going to have a couple slides about Quest Trust Company, who we are, what we are about, and how this works. And then we'll get right into the presentation. All right. So thank you so much for joining us. Of course, who is Quest Trust Company? We are the largest self-directed IRA custodian in the great state of Texas. We have about 20,000 clients across the country. So no matter where you're joining us from today, we are happy to help you with your self-directed IRA needs. We have about $2 billion of assets under administration. So we have lots of people that have their funds with us under administration. So that's really exciting. We have about $450 million in undirected cash. So think of that as the big opportunities. This is cash in our clients' accounts that's just sitting there uninvested. So this is really big opportunities for lending it out, for borrowing, for investing in new opportunities. So lots of opportunity there. Of course, our disclaimer, Quest Trust Company, all of our webinars is for educational purposes only. We do not give any tax, legal, investment, structuring advice. Please make sure you are getting in touch with your CPAs, your attorneys, your financial planners, your tax preparers before engaging into any investors. Please make sure you're doing your due diligence on all of that. Keep your investment safe. All right. So what is a self-directed IRA and why do you need one? I'm so happy you asked. So self-directed is honestly a completely made up marketing term. In a legal sense, a self-directed IRA does not exist. An IRA is an IRA according to the IRS. So an IRA at Fidelity is the same legal IRA that you would have at Quest Trust. Quest Trust Company. So self-directed means you are completely and totally in control. You are directing the account yourself. You are telling us what you are wanting to do. Our role is the custodian, and we are facilitating the transactions that you are asking us to. So here at Quest Trust Company, we have an open architecture platform for you to invest in private assets, giving you so much control in what you are invested in. So of course, diversification and an asset class all by itself. Private assets are so abundant. There's so many different things, from cattle, oil and gas, private entities, real estate in all shapes and sizes, notes, etc. There are just so many things in an asset class. It's diversified on its own, or in a portfolio, a retirement portfolio on its own. You can have your public assets, your private assets, kind of whatever you're filling your circle with, in addition to your diversification. Tax savings. So all of our 7 accounts at Quest Trust do have some sort of tax savings. They're either growing tax deferred, where your funds are growing tax deferred, so you're not paying taxes on them at the time, but you're paying taxes later, like in a traditional IRA, or like in a Roth IRA, where you're growing that tax free because it's an after-tax account. Of course, call your IRA specialist. We would love to help you with these accounts. Social investing, another great thing with investing privately, you're choosing what you want to invest with, who you want to invest with, who you want to work with. So maybe you're providing someone a mortgage who can't get a typical one through like social financing, or maybe you're investing in your local company, local community, whereas investing publicly, maybe you can't do so. And of course, invest in what you know best. This is where you get to use the education you already have to help yourself invest for retirement, or use these resources to invest privately. So if you already know a lot about real estate, multifamily investments, or lending, or notes, or oil and gas, what have you, use the education you already have to invest here. So a lot of great advantages there. Investment choices, I really think this is a short list, but this is just kind of a general asset class. So private entities, notes, real estate, all shapes and sizes of kind of all, but this is just kind of an example, but truly a short list. We have people with cattle, all kind of different things, cryptocurrency. So just an example there of all the things you can do in a self-directed IRA. At Quest, We love our free education and networking classes that we can provide to you. So Tuesdays and Saturdays at noon, we love to have you here at our webinars. New speaker, new topic, always giving you more education about self-directed IRAs, investment opportunities, due diligence, tax things coming up, etc. We love helping you out. We have our online national networking happy hours because not everybody lives in the great state of Texas. I love to host this event. November and December, we have moved it up because the fourth Wednesday of the month happens to fall right around the exact Thanksgiving or Christmas holiday. So please check out the calendars. The events have changed. I'm going to put the links in the chat box for the one coming in December. I don't want you to miss it. And then our in-person classes for those of you in the Texas area. Houston is going to be on the first Tuesday. Austin is the second Tuesday. Dallas is the third Tuesday of the month. Always in our offices, 6:30 Central. Come network, meet some new people, have some food, have some drinks, get some education. There's always live deal pitches after the education piece. So feel free to come up and deal pitch while you're there, or listen to the deal pitches and get some more opportunity education. So we'd love to have you come join us. I'll put some links in the chat box or the comments box of how to get this information. Of course, last but certainly not least, we have our, sorry, that was Quest Expo. Sorry, this was supposed to be hidden. Of course, it pays to have friends at Quest. Any account that you refer to Quest, if you're a current client and they open an account, you each get a $25 credit. You can use the website that you see there to access this, or you can contact your local IRA specialist. We'd be happy to help you to get this referral credit. And of course, I just put the slide in there. It didn't put it in there. I'm so sorry. So it's supposed to put a QuestCon live website in there. I am going to put I'll put the link in there. So QuestCon Live, Quest Expo was amazing. We still have the recording available if you would like to get it. But QuestCon Live, I apologize if the slide didn't get in there. QuestCon Live is coming up December 9th and 10th. This is our annual virtual event, wrapping up 22, forecasting 2023. We've got some great speakers, great panelists. We're going to have a networking happy hour on the first day on the afternoon of December 9th. So it's going to be December 9th, December 10th. It's a Friday and a Saturday. Great education, great panels, great opportunities there. So I'll put that information in there. The tickets are about $69. Current clients, we have some codes for you to get some discounted tickets. New clients, we have some codes for you to get some discounted tickets. I'd love to give you those codes. So I'm going to put some contact information in the chat box to get you all that information. Okay, way enough for me. I know that you really came to listen to Mr. Vincent Celeste to hear about the changing economy and investing in multifamily syndications. So please welcome Mr. Vincent Celeste. We are so happy to have you. Thank you so much for joining us today, sir.
Thanks so much, Nicole. I know both of our organizations really take education very seriously, so happy to be here.
Absolutely. We'll take it away. It is a pleasure to have you.
Thank you so much. Yeah, I have two screens happening here, which is why I'm doing the weatherman news reporter turn here. But yeah, really excited. We're going to be talking more about multifamily real estate investing in today's changing economy. Really putting some charts onto kind of what we're all feeling, right, in the atmosphere here. So first, a little bit about us. If you're not familiar with Derosa Group, here's a glimpse of our team, and I'll take a step back to and kind of define what we do here. We purchase large multifamily real estate in the Southeast United States. So we're looking North Carolina, South Carolina. A lot of our portfolio is also in Kentucky. So we're talking large multifamily apartments in those markets. Our founders, Matt Faircloth, he's written the book on raising private capital for bigger pockets. And the other partners are Hervé Francois and Justin Frazier. So yeah, really excited to be here. You can see me at the bottom there. I'm the equity sales manager here. And a big part of what I do is educating folks about what we do and helping kind of put some color to what we're all talking about. So put in the chat box, let me know where you guys are coming from. Are any of you general partners yourself? Or any of you guys limited partners? And where are you in the country? Definitely, as I'm going through, feel free to put your questions out there. If I don't get to it while I'm presenting in the moment, we'll definitely have a Q&A at the end of all this, and we'll get to all your questions, certainly. So, all right, let's dive in. So changes in the economy, just like we spoke about. I mean, the next slides are going to go into a little bit more detail, but we've been in this world for at least the last 4 or 5 months. I think we're all feeling what the premise for this presentation is for, right? Raising inflation, rising interest rates, wage inflation, economy shortage. Supply chain shortages. All this makes things difficult. Not only on the acquisition side when you're purchasing a property, but it makes things difficult from an operations standpoint as well, right? Supply chain shortages, labor shortages for doing work, and a big part of what we do at Derosa Group is repositioning these large multifamily properties, right? Our motto is transforming lives through real estate. It's there at the bottom. We try to do that really through 3 avenues, right? Of course, education, like we're here to do right now, helping people learn more about what we do and helping people to understand there's a way to make passive investments and earn income passively. The second branch of that is by improving the lives of the people in the apartment buildings we purchase, right? So there's a right and wrong way to do things. And we want to make lives better for everybody that is in this atmosphere, right? And then thirdly and lastly is our active investors, of course, returning a great return for them. And all that is impacted by the changes of the economy because it affects the way that we're able to get deals. And then, of course, it's going to affect the cash flow and execution as we're working through. So, all right, I see some comments. Yeah, keep them coming if you guys can. All right, continuing down here. Until recently, right, you would hear of apartment syndicators like ourselves, basically flipping apartment buildings, right? We're talking large multifamily apartment buildings, hundreds of units at a time. People would buy them and sell them in a year, just like you'd buy and flip a house, right? That's probably or definitely not going to be the case in the go forward. And I'm going to be dipping in and out of, we're going to be going through 9 steps and 9 things that we think you should look out for when you're looking into a multifamily syndication or looking to get in place an investment like this. And what I'm alluding to right now is I'm going to be dipping in and out of this as a constant kind of thread, right? It's not going to be the case now where you can buy a multifamily property, flip it in a year. Assuredly, maybe you can, maybe you do something really well, right? But that is not something that I think folks can count on in the future. And what you should count on is cash flow, longer term holds, and really looking at the life cycle of a property, right? And having a good business plan that you can execute certainly against. So that's what this slide is meant to summarize. Let's continue down here. So these, right, they change frequently. So these are the latest and greatest at the time of making this chart, but we're all feeling it, right? We're all feeling what these charts are showing. And without these line graphs, I think we all would know what's happening with inflation and wages. But there is a punchline here I do want to highlight. So inflation, of course, we know what's happened in the last few months or so, right? Wages also, people talk about wage inflation frequently. And you look at this chart and you see it going up and up and up. And that's one relationship that's apparent, except what's not apparent, and I don't think what jumps out of these just by looking at these 2 charts is wage inflation is not increasing at the same rate as rent inflation, right? And so you'll hear of operators increasing rents 20-25%. And the market may sustain that. The market may say that's what the market value of your 2-bedroom apartment, whatever square footage it is. They may say that that's what you can charge. But the people whose lives are most divided, the tenants, their wages aren't increasing 20% a year. I think we all would love to get a 20% raise every year, right? It's not happening though. So there's definitely pain, from that regard, and it's something that all operators should be aware of. And it's kind of a lens that I think we should all, when we're looking at these properties, kind of put ourselves through, because it's going to affect occupancy, renter sentiment, and eventually, and lastly, the returns of the property, right? When occupancy dips, that's your number one impact to the NOI, right? And again, so let's put questions in the comments section here, and I'll answer any questions if I'm dropping terms like NOI or anything you want me to touch base on later. Let's connect on that. Anuhuma, thank you. Houston, Texas, looking to be informed and educated about this. Glad you're here. Tom's Cry. I'm doing good with the last names. It's a battle for me. Grand Prairie here. Want to know how to stagger into syndications and not risk total loss with a single economic crash. What variables, cap rate and DSCR? Great. That's a great general question. I'm going to answer that. I'm putting a pin in there. I'll tell you how we do throughout this presentation if I get to that. But keep them coming, because I may dip into it as a conversational piece as we're going through too. So if we don't change course, rates are going to continue to increase. This is something that we're feeling now, right? As general partners and people trying to do this business. Deals, if we don't change course, deals aren't just not going to work, right? Because the debt service to get into these properties is often, it just doesn't facilitate, to your point, Tom, I think, DSCR that's going to be favorable to our investors. And we still, I'll caveat this and dip into for a second. We still are underwriting our deals for an 8 to 9% preferred return for our Class A investors, and we have we feel an obligation to find deals that way. And after you're done underwriting, after you're done getting the loan in place and everything's figured out, it just doesn't pencil out. So there are certain things you're going to have to shift course here and maybe try to implement to keep your business going forward. And so that's really what we're trying to do. Let's see, rates increase to the point that deals don't cash flow. Just like I said, the market then drops and no cash flowing deals can't be sold anymore. Right. It's continuing down this. It's kind of like a snowball that's perpetuating itself. So it's going to require you to be creative, get creative financing, but also creative deal structure. And then we'll get into more about that in a little bit as well. All right. So like I said, 9 actions. Let's see what we're doing specifically to tackle all these things. First and foremost, most is paying for the talent. This is, maybe another leg of the transforming lives, right? When we're underwriting a deal, this is another common thread I'm going to, weave throughout this presentation. It all comes back down to the underwriting. Every action 1 through 9 that we're going to go through should all be reflected in that underwriting, so that that you have a business plan that is accurate to today's, global economy, or today's landscape, right? So paying for talent is one of those things that not only is it important to do from an execution standpoint and retention standpoint, maybe that's obvious, but what's really important to do is to have that be reflected in the underwriting that you're putting together, right? So we want to really align our interests with the property management company, with our employees, and try to align our incentives so that we're all on the same team here, which should be apparent and is the way we try to push things forwards, right? So incentives for meeting goals. Let's put an actual example on this. One incentive we have is when our property management company is able to finally get over that 95% occupational occupancy threshold, they are compensated for that, and it helps, right, to execute the business plan and align our goals in that way. And it's just it's the right way to reward people, throughout this, right? And so we try to retain talent, and we try to focus on getting the best crew we can possibly get. So let's continue through with that kind of idea in mind here. Fixing our so this is another one. This is why, right, people can't flip apartment buildings anymore like they used to. Interest rates are rising so much that so let's just go through a typical syndication. And when I say typical, let's say this is something you often see, right? You often see an operator purchase a property with a floating debt for the first 2 years, and they're going to do the repositioning. They're going to increase the occupancy. They're going to add value to all the units and get everything spick and span and moving, right? And get that property singing and making a lot of money. By that time, 2 years probably passed, 3 years maybe passed, and they're going to refinance into the longer term debt. So there's 2 things that we really try to do. The second bullet saying new deals need to go under fixed rate debt, and that's true. And we're always looking for that fixed rate debt from day one. That's the best case scenario. And if it's not possible for the deal structure, what we always do, and we have been doing for quite some time, is purchasing a rate cap. And today, if anybody hasn't done that, I think we can all imagine the pain they must be feeling. I think interest rates right now for these types of assets are in the mid 6s, right? And before, in March, we just bought a property and we secured, it was 600 something units with 3.1% financing. And so now we're talking, that's double the interest rate. You can imagine the debt payment that goes on these multi-million-dollar properties and what that can do to cash flow. And as I alluded to before, cash flow is really what's going to help you muster the storm, and it should be really what we're looking at when we're identifying the opportunity here, right? So I digress for a little bit, but right, going back to the point, rate caps. If you can't get the fixed debt, you should fix your interest rate by purchasing a rate cap. And I'll define that just for a second too, for anyone who's not familiar. A rate cap is when you have a floating rate, like in the beginning, like we're talking about a bridge debt, maybe 2 years, it's a floating rate off LIBOR or something. So what you can do is you can purchase a rate cap, and what you'll do is you'll give a big lump sum payment, and that's something that's also going back into the underwriting, right? You should understand that you're going to have to pay for this rate cap, but you pay basically an insurance. It's kind of like an insurance group, right? And you're going to pay them a lump sum, and they're going to cap your rate. So they might cap it at 6%, and then anything above 6%, they're going to pay your original mortgager the difference, right? So that's what I mean by it's like an insurance policy on your rate. So if you can't fix your debt, you should definitely buy a rate cap, or you should make sure that the operators you're going to be working with do. Get creative just goes back to, what is that, slide 2 or 3, right? There are many ways to get creative, and it's all linked together, right? We're going to be talking about getting creative financially, getting creative with the seller in terms. But let's look a little bit more at this. So there's many ways to get creative too. What you want to do, what we're looking to do is develop more strategic partnerships, right? More equity partners that might bring a different skill set to the table, and try to find synergies that will increase the opportunities for everybody. Another good example of this is seeking new debt outside of agencies. So, going outside of Freddie, Fannie, and we're working with some family offices, insurance companies, people who are looking for real estate backed, right? That's one of the great benefits of multifamily real estate, is that your cash on cash return, or your preferred, like I said, 8 to 9%, sometimes your 9% preferred return is backed by multifamily, and you'll get paid out before the general partners get paid, or the Class B investors get paid out. So agencies like family offices and insurance agencies are really excited about that kind of fixed income stream that is backed by something as solid as multifamily, which again, if the operator does correctly, they bought it and it's cash flowing to meet all these debt obligations. So that's another great way. And then sellers, right? Getting creative with the sellers in terms. Here's a really good example of this. It's one of my favorites. We bought 600 some odd units in March. And what this was it's actually a 5-property portfolio across Kentucky and Winston-Salem. Now, the creativity there is really because we're leveraging relationships in both areas. And what I'm most excited about, this deal is closed and it's passed and we're operating it now. But what I was most excited about there is that it's not like one seller came and had to sell 5 properties. We happen to tie these opportunities together into one capital raise. So we get better financing. We're getting the economies of scale of the partnerships we have in each one of these markets. And we're able to fix more of our debts and costs because of the bulk pricing you can get by doing things like this. So that's one way to get creative with the terms and all that. So let's continue down here. Costs. It's very similar, right, to what we're talking about before, and leveraging economies of scale. There's many ways to fix costs, and as we're describing before, Derosa Group's thesis really is to buy workforce housing. And now workforce for Freddie and Fannie it's not like Section 8 housing or anything like that. We're talking blue collar demographic workforce housing. We target that to be in the middle of the market, and like I said before, we're always trying to reposition these properties, add value, get contractors in there and make them a more beautiful place to live in, a place that everyone's happy to call home, right? So there's a significant amount of investment that goes into that, and not even the purchase of the property, right? So one deal I have in mind in talking about this is $3.7 million of just capital improvements to the property, which has more than doubled the property value, in retrospect, and helped to increase rents, but also make people very happy to live there. So to do that $3.7 million investment smartly, you should try to fix some of the costs of that and get the most effective economies of scale and leverage business partnerships where you can, right? So let's go through some of the examples here because I really do like them. Our general contractor in North Carolina, right? Not everybody uses general contractors. Sometimes use a property manager who's going to collect a project management fee, right? If you have a large capital improvement happening. We in North Carolina have a really great relationship with a general contractor called THS, and they do pretty much all of our work there. And here's what's great about that. Our general contract is, we put together a scope of work and we contract them to do that scope of work, and they're taking the risk of movement within that budget because we've agreed on the budget. And then going back to kind of the through line through all of this, that's underwritten in the deal when we first got it. So it's everybody, we're able to ensure their payment and also ensure the returns that we are comfortable giving to our investors. And that's one way that you can really fix costs here. I'm going to skip over to 4 right now because it's tied into this. When the general contractor is doing that, buying in bulk, some of our properties, 330 units or a single property, right, or something like that. You don't really want to go to Lowe's to just buy 300 refrigerators, right? So we have business partners in place and other distribution centers that we buy these appliances in bulk with, right? So that really helps the general contractor keep their costs down. It keeps everybody happy and is in a good way to operate. So staff, I'm going to go backwards now, but staff, right, underwritten in the deal. We already said action number 1 is pay for your staff and make sure they're well taken care of and happy, and put that in the underwriting. And property manager in Kentucky, we have one property manager in Kentucky, and we have about 1,200 units in Kentucky, and that's leveraging the economies of scale here. And it's also helping to fix the cost of that whole portfolio in that metro, right? Bob's saying, let's see, assume an investor isn't relying on cash flow, but still expects a 14% IRR equity share when an apartment investment sells in 4 to 5 years. Given your projected market performance, it's actually blocked by this chat box, but is this a realistic? I think is this realistic? It is, yeah. That is realistic, and that is something that so 4 to 5 years IRR for somebody. It all is deal specific, and so one way that and I'm going to digress here to answer the question, because I think it's a really great as we're talking about underwriting deals, because it's a constant theme of this really presentation. So I do want to address it really quick, right? That is absolutely a possibility, and it's the way that deals should be underwritten, right? At 15 to 20% IRRs is a target that we always have, and we do think that is a possibility. And it goes back to underwriting, making sure that you're doing all the steps so far that we've described, right? Because we've described some important ones like fixing debt and fixing costs. And if you go through the underwriting and you can make that happen, that's when you pull a trigger. And we are optimistic about that being a possibility, as long as you're getting creative and putting the pieces of the puzzle together. That is absolutely a possibility that I think folks should be looking to, and maybe a threshold that people should set for themselves as far as expectations go. All right. So continuing down, the same thing, right? So just like we're talking about, and Bob, great question, because you beat me to the cash thing. We do purchase for cash flow because I pause on the 4 to 5 year hold period note. But what we do is we underwrite deals for cash flow. We want to make sure the cash flow on day one, and that means that we can kind of hold this property for as long as it's opportunistic for the investors. And what you should try to do is provide off ramps. An off ramp could be refinancing. An off ramp can be a secondary equity exchange. Connecting investors who want secondary equity in stakes. So cash flow is king. I want to address this slide though. Buying properties that are cash flowing day one will allow you to weather this storm. And one thing, if Matt was here, one thing I'm happy, Matt Faircloth, the founder, he was investing through 2008. And what he would tell you is that the reason that he was able to weather that storm was because he purchased for cash flow. The other way that you're able to weather storms like that is by increasing the intrinsic value of properties, right? This is something people really understand in the flipping space, right? In residential space. But if you're going to increase the value of a property by 50% by renovating the kitchen, bathroom, adding bedrooms, et cetera, and the market dips 10%, you're still in the green, right? So rather than if you just bought that property and was just hoping that it was going to, increase in value. So you want to force appreciation and you want to buy for cash flow. That allows you to hold these properties for however long is opportunistic, especially when you fix the cost and you fix the debt, right? Because cash flow day one could be different than cash flow day 365 if it's variable debt, right? So cash flow is king. It's going to protect your asset. It's going to protect your investors. And it's going to allow you to really hold the property and execute the business plan that you want it to do, right? Because some people are going to be forced to sell, I think, in this economy. And that's something that we're all seeing already and feeling already. Those operators who thought that they can buy a multifamily apartment building and then flip it, like we were able to do for maybe the past 2 to 3 years, you're going to have to actually operate these properties now. So cash flow allows you to do that. All right, creative financing, another thing that we touched on before with getting creative in general, right? So fixing agency debt, local commercial banks, and other alternatives. We touched on some really good ones, right? The insurance companies, family offices, people, anyone who wants exposure to real estate that is high up in the waterfall. And by waterfall, I mean the order of precedence in which people get paid out. Usually the agency is going to get paid first, maybe even always, and then your investors collecting the pref are going to be number two. And the general partners or the operators won't get paid until all the investors are paid, right? So people who like that idea of getting exposure to multifamily real estate, getting that income that is also backed by an asset as reliable as multifamily, when somebody's done it the right way and it's cash flowing day one and you can meet all your debt service, anyone who finds that attractive is going to be a good creative financer of potential deals. So family offices, insurance agencies, it's important that people are starting to look at some of these other options and kind of keeping their minds open, right? All right, action 7, conservative underwriting. This is action 1, 2, 3, 4, 5, 6, 7, 8, and 9, right? It all goes back to the underwriting. Everything that I said should be reflected in there. But I do want to extrapolate off this even more, right? So conservative underwriting, that it goes well beyond just like what we talked about. It goes beyond just reflecting accurately the current state, and it gets into even more trying to be conservative in your projections as well, right? So if you're still going to underwrite your deals for a 15 to 20% rent bump like we had last year and maybe the year before, it would be a mistake. And if you're counting on cap rates, to compress more, I think you'd be making a mistake at sale. So ask your questions away about cap rates, NOIs, and stuff if you'd like me to touch more into what I mean by all that. But yeah, so it more than just accurately reflecting everything we talked about through actions, 1 through 6. You also have to be conservative in the go forward as well, right? So exploring the new normal. This just goes back to what we were talking about with cash flow and how it allows you to hold properties longer. That is part of the new normal. The other part is getting creative in your business trajectory and your focus, right? So we are, not to discredit everything we're just talking about, right? And there's more slides on this. Multifamily investing, I think, is something that obviously I'm optimistic about. Everybody's whose pictures you saw earlier are optimistic about. But we do also feel that it has a place in everyone's portfolio, but is not the only way to invest, right? And so we, as operators, are also interested in other ways to transform lives through real estate that also expose investors to real estate assets and provide great returns, to remain true to that thesis, right? But maybe a slightly different approach. And so here's just an example of that, is maybe taking some of our apartments and serving a need for medium-term rentals, like 30 to 90-day rentals. So high quality medium rents, I almost alluded to it at the conservative underwriting. This is one of my favorite ones that we talk about. And it goes also back to the thesis here at Derosa Group. We serving workforce housing, right? Serving that demographic provides some stability that I don't think every asset class could accurately claim, right? So having high quality medium rents and serving the middle class is a safer business practice, in my opinion. And one thing we always try to do here at Derosa Group is we're not trying to meet and exceed the medium rent of an asset, right? So if you're taking a Class B 2 bedroom, we're not trying to be the most expensive person on the block. We're trying to be somewhere in the middle. What Matt would usually say is take the medium and discount it by 10%. That's where we want to be underwriting to, and that's where we want to be because that's going to help people the most, right? It's setting a real expectation, and it's also going to help us keep that occupancy to a place where we are going to cash flow the way that we project to. So it's important to going back again to the underwriting. It's important that to understand what the market requires, understand the expectations of the demographic, and try to meet those expectations in the most efficient way possible, and understanding the dangers of possibly exceeding those expectations because you might not get a return on that investment, right? Let's continue down here. So, but the long game. I've been saying this throughout this presentation, right? It's very important. And it's something that I think we're all really passionate about here. Just like you said, people for the past 18 months, probably longer, have been able to buy large multifamily, have it double in price, and sell it in a year. And it's been, everybody's been doing it, and it's been great, right, for everybody. And you can't knock that, right? Returning capital to investors, and everybody's happy. But it's important to understand that your operator and operators will need to develop the skills in the new economy as well, and the new way things, I feel, are going to happen, right? You're going to have to hold these properties longer term, and you're going to have to actually operate them, not like before, not like where you can buy an apartment and you're a construction company and can fix it and then sell it. You actually have to operate it as a business and with a long-term strategy plan. So I would like this statement a lot. The winners in today's new economy will be those willing to hold and cash flow for the long term. So again, this actually threw in at the last minute because I think it's really important here, and I want to point it out. Not to discredit the multifamily, right? Because that's what we're here to talk about, and I'm really excited. And at the end of this, there'll be a contact us slide, and you can always please feel free to reach out to me. We can talk privately about anything you'd like, multifamily or Derosa related. But I do want to put a pin in this, and also take a second to recognize that it is one piece of a puzzle that I think is a well-balanced portfolio. And so here's just, I think, a lot of stuff that we all are aware of, but just, I want to pay tribute to really quick that there are many ways to make passive investments, and there's many ways to earn equity even. And real estate is just one piece of that puzzle. I particularly like it because it's backed, right? It's a physical asset that's backed, and you can get some really good repeatable results that are with tax advantages, and good repeatable results that are backed by a physical asset, right? All right, so as I promised, here's the contact us slide. I'm going to be able to click through the rest of the slideshow, answer any questions as they come in, but please feel free to scan this with your phone. You're going to see everything that we have to offer here. There'll be ways to connect with me personally. I'm always available to connect with a Zoom call or over email. Heck, I give out my personal cell phone number all the time, right? So definitely reach out, and I'm happy to connect with you all. Again, so what we do here at Derosa Group, transforming lives for real estate, really has three arms. It's giving passive income opportunities to investors. It's transforming the lives in maybe an obvious way for the people who live in those apartments, and then also trying to educate folks so they can do either what we do, or they can learn how to be more conservative and safe if they're going to be an LP investor as well. Right. So scan there. That's going to show you everything we have to offer. We have an event coming up, I will say, in December 7th to 9th. The first link in there is going to be a way to connect with us if you want to dive in even further and meet Matt, the group, and everybody. for a couple of days. It's a retreat. So definitely feel free to jump on my calendar anytime. And I'll open it up to questions. I know that I skipped over one, so I'm gonna go back there. Tom, what variables to study besides cap rate and DSCR? See, Tom, I'm glad you bring this up actually, because I was thinking this with cap rate, right? Cap rate is a historical metric, and it's always the first question that I think people ask, like what are what cap rates are you seeing? And those sort of questions. People are usually very hesitant to say what cap rates, because it's affected by several things, right? Like different asset class, even in the same market, will have a different cap rate. It's also affected by where you're investing and all these things. The other thing that I think makes cap rate a dangerous measuring stick these days is cap rate uses NOI, which, as you maybe know, doesn't take into consideration the debt service. Net operating income does not look at debt service that's below the line. So you could probably tell where I'm going with this. Right now, what we're talking about with a lot of people have variable rates when they're purchasing these deals. Cap rate is it completely ignores the fact that, like I said, we had an interest rate of 3.1%, and now we're getting quotes for like mid sixes on interest rates, right? So it won't take into account doubling of the interest rate and the effect that's going to have on your debt service. I like debt service coverage ratio a lot more. That is one that we use as a pretty close measuring stick, and it's only after, right, you've been conservative everywhere, right? We're talking conservative in the payroll, conservative in the estimations of rent increases throughout the line, conservatives in the tax reassessment, conservative in the insurance increases, right? All these things. After you're done all that, and you're all conservative in also the only debt and how that's going. After you're done, the debt service coverage ratio, I think, is a really good measuring stick, and I think that's probably what I look at most closely when I'm looking at a deal. And it's only after you've been completely conservative in your underwriting. All right. Let's see. I don't see any more questions, but we were talking about cap rate and all these things. Let me touch on that, right? So cap rate, capitalization rate. If you go on YouTube, I guarantee you someone's going to explain this with a nicer, like there'll be a graph and there'll be things move around and it'll be really nice. So I encourage you to do that. But let's talk for a second about cap rate. It's really the net operating income, which is the operating income, minus the operating expenses. Again, operating expenses are not debt service. So net operating income is just looking at what you'd call above the line. It's only looking at the net operating income minus the net operating expenses, right? So it's the profit basically, but minus the profit minus the debt service. And then if you divide that by the purchase price or the market price or whatever metric you're looking at, right? Like it could be the market price. If you divide that, you're going to get cap rate. And so cap rate is what people do often use to measure really commercial assets against each other. All commercial assets, we'll look at cap rates. The reason you do this, and I think it begs the question, why leave the debt service out? That's like the first question I had. It's because operators all do different things. Somebody can buy a property with no debt. They can just buy it. And so everybody's situation is different. Especially, let's talk about big private equity firms and stuff. They're able to get debt financing that operators like ourselves aren't able to get, and so it's all different. So the way to make it apples to apples by ignoring it, unfortunately. So that's why I caution the use of cap rate. But cap rate equals net operating income over purchase price. And what's exciting about that, what makes multifamily real estate kind of really, really lucrative, to be frank, is the purchase price. Now you can understand has an inverse relationship with cap rate too. So if you're able to increase the income of your property, and you can do it through this is the other great thing about multifamily. You can increase the NOI by increasing occupancy. You can lower your expenses, and that will increase the income. There's many ways to increase the NOI overall. After you're able to increase the NOI overall, if you divide that by the market cap rate, then that's going to show you what the purchase price is. So we can go through some examples here. I don't know. I want to keep it open to questions about the subject. And if we want to talk more about that. But yeah, that's cap rate. That's the effect, and that's why I think now, after explaining it more completely, why cap rate's a little bit of a risky measuring stick these days. It ignoring, one of the largest factors that is making deals so hard to do right now. We have a whole arm of our business, right? Let's go back over here. Let's look at the team again. We have a whole arm of the business. People will spend all day, every day, looking at markets, building broker relationships, putting out offers, and doing this. And we're going as fast as we can, right? This is kind of how I like to put it. That team is hard at work all the time, going as fast as we can, but we're also being slow at the same time and conservative. And what I'm told by Hervé and Haith, most often things don't work out because they just don't cash flow. They don't. After you have the debt in place, they're not going to cash flow. So that's why I, especially right now, cap rate is not the number one thing that I look at. Let's see. Do we have any other questions?
I have a few.
Nicole, how do you think I did?
I think you did great. I actually have some questions.
I see her back.
Can you hear me?
Gotcha. Yeah, loud and clear.
Okay, perfect. So I always learn a lot from hosting these, and I always come up with my own page of questions and notes. One of the perks of getting to host these is I always get to learn more about these too. So multifamily investments, syndications are very common investment for a lot of our clients at Quest. We get a lot of questions about these, how they work. Cap rate is a huge question we get. And it's interesting that you thank you so much for that explanation. I think that was really valuable. And that's definitely something that people just ask about, like, what is the rate? And I think it's great that you had that explanation, that there's so much more to look at than just that. And the one thing that you said is the debt is not, I'm sorry, if the cash flow is not in place, then it's something that you're just not going to do that. And one of the things that you just commented was because of the debt, the cash flow was not there. Is there an average debt percentage that y'all cited that y'all tried to stay within? Or is there like a certain percentage of cash that you try to raise? Or is there like a metric that y'all try to stay within that in considering that?
Yeah, that's a really great question, and it's actually such a balancing act. That's why we operate the way we do. We don't, when we raise capital, we're raising capital for a deal specifically. So I always caveat answers to questions like this, because when we're talking about something specific and there is an actual offer on the table, it'll be very black and white, right? But I do want to answer that. I do want to answer generally and not beat around the bush too. So one thing you'll find is that agencies are not as quick to give you the 85%, 80% loan to value. That's just, I don't know if it's dead and gone for good, but that's one thing I've heard is it's not really happening as often, right? So by our choice also, and because of these factors, I would say we're looking at a lot of 70% loan to cost, like a lot of 70% loan to cost. That's a good balance between, risk exposure and also leveraging, right? Leveraging the main benefit of real estate, every asset class, single family homes, no matter what, is that you can leverage, financing. So, but yeah, to give you a black and white answer to that, I would say like 70% loan to cost, something like that. And regardless of that distinction, the agencies are kind of pulling that rug anyway. So.
Awesome. Thanks for that. Tom actually has a great question that I get all the time, and it is about UBIT, or unrelated business income tax, related with debt leveraged assets within an IRA. So this is one way an IRA can occur a tax. And some people say, oh my gosh, I hear a tax. This is terrible. I don't want to be invested in this anymore. And I challenge that, because UBIT, although, and of course we teach like an entire class about UBIT. I am really, really happy to help with this. But so UDFI, or unrelated debt financed income, is which causes this UBIT. It's just one of the IRS things that they've set, that this is one of the ways that an IRA can incur a tax. But there are great solutions to this. It can be reduced by depreciation and expenses. You need to take your K1 to your attorney. They can reduce it. This is an expense for your IRA. It's not a personal tax. This really can be something that doesn't need to be that big of a deal. It does something that needs to be addressed. And of course, taken care of. It's a tax that the IRA does need to pay. But your accountant, we have other resources for you. We have tons of videos for this. So any UBIT, UDFI questions, IRA specialist at Quest Trust Company, I'm happy to help you with this. We have, I'm about to put my cell phone number in there. As much as I would love to talk to you all the time, I'm going to put my work number in there. I'm going to put my work number in there. You can call any of the IRA specialists. We are very well versed in UBIT. We have a lot of experience on this. If you go on our YouTube channel and just put in the search bar UBIT, you will find, I can't even type my email address in here right now. I can't find my glasses. There's tons of resources in there. I just put my contact information in there. So amazing question from Tom. We have used some UBIT solutions. So just because you hear about a UBIT tax, people think tax, oh my God, this is terrible. It's not. It's a very manageable thing. We've had clients with extremely large balances, and then their UBIT tax is it's really just like a couple thousand, and then it's like a couple million in return. And to me, that's something I'd rather to pay, but of course it's a personal choice. So we have lots of UBIT resources. UBIT is not a bad thing in fact, if you have UBIT, that means that you've made money on your investment. So we think UBIT is a good thing. Means you've made money, and it's just a little something we need to work around. It's an expense to your IRA, and there's lots of solutions for that. So very, very, very easy thing. We can work with you. Happy to help with UBIT. We have a new question from Mr. Bob Sand. Is it practical to expect a sponsor to provide an annual, preferably semi-annual investment profit or some measure of investment total return if the apartment complex were sold then? That's going to absolutely be a question from Mr. Celeste.
Yeah, I was going to say, I'm glad you took the UBIT question. I could probably take it. Bob, I'm sorry. I was reading this. Forgive me. I'm a little confused by what you mean. Apartment complex were sold then, like it was sold. I would assume you should get a profit if the property was sold for more than, the syndicate bought it for. Are you talking about? You're talking about a return. Yeah, I would. You should get a return when the property sold and the syndicate is over. Really, and let's go back a second to more about syndication.
The other way I could read it, please. Oh, I'm sorry. After you.
No, I was going to just comment to help maybe paint a bigger picture here. A syndication, right? They're really like their own businesses. They're all separate businesses. And so really what you look at, like Derosa Group, we number our capital raises. Right now would be up to DC 17. The last one was DC 16. So DC 16 is a business that owns assets, right? And so when that business has liquidated all its assets, it should return a profit to all the people who own equity in that business, just like anybody who owns equity in any company. So that's kind of my stance on that. I hope I answered your question. Okay, so Anumaha, when you improve properties, do you look for opportunities to increase income from renters through amenities such as covered parking spaces, storage hubs, etc.? Absolutely. And actually, you can look for ways to increase revenue, even without tapping into the residents. Like one thing we did actually was put an Amazon locker. Now, I'm not the guy to talk about. I don't know what that turns over. I'm not sure what type of revenue that produces, but it was interesting to me that we found that to be a useful amenity to put in. I haven't heard of that in too many places. So Amazon lockers. Another one we did actually recently. We're building like a dog. Let's go back to talking about. I really love the idea. It was not my idea, but I really love the idea because you're going to get all the increased revenue from people actually who want to do the dog washing station. But you're also going to get increased revenue because you can charge a pet fee, right, for people living in the apartment complex, and it welcomes people more, right? If you have a dog, that might be a place that you'd be more happy to live, a place with the dog washing station. So it's like a win-win-win, right? So yeah, absolutely. And that I think this points to another arm of this same body. uh, Reducing expenses is one thing that we do focus on very heavily, and the number one way we reduce expenses by reducing our utilities. So we're looking at like low flow toilets, putting in LED lights. When we're targeting, right, because we target workforce housing, we're talking about properties that are built in the 70s, often maybe 80s, 90s, right? um, there's room to make that property more efficient, from an energy standpoint. And not only is that just a good thing to do, but that also will reduce expenses, um, and help increase that NOI as well. So
All right. I have one last final question for
anybody else?
you. I don't see any new questions, but I have a final question for you as we're coming up on the 1 o'clock hour. What is your so for first time multifamily investors? Because we do get a good number. Oh, I'm sorry. Bob Sand has a clarifying question. What I meant was, should a sponsor be able to tell me how much my investment has increased each year, like every 6 months, as we go through a 5-year hold period? I'm guessing that means like over the 5-year life of the
Yeah,
asset.
yeah. And I don't. So every operator is gonna be different, and I'm trying to be careful to not. I don't know. Let's be frank. I'm trying to be careful, not throwing anyone under the bus. There are different ways to run the business, and I'm not sure what arrangement you have, right? But I will say that I think it's reasonable for you to ask that question, and I do feel like it's reasonable for you to have an expectation for your a general partner or your operator to understand the property value. There's several ways to do it. We always get a broker opinion of value each year. We do cost segs as well. All these things are kind of requiring you to get opinions of the value of the asset. There's also, if you're operating the asset, right, and you're looking at the books each month, each quarter, we send quarterly financials, right? So we're going to send very black and white quarterly financials. We send monthly updates in the investor portal of what's happening, right? But we're sending these quarterly financials, and what I'm getting to right now is the other way to assess value of a property. You should know, the operator should know what the NOI is, right? The operating NOI. They should know what things are doing, and they should also know what the market cap rate is. So, um, not to discredit the whole conversation about cap rate being maybe like a weird metric, but that is still the metric that people use to kind of appraise these buildings. So I think your question's, yeah, reasonable expectation to have, in my opinion.
Thanks so much. We have one more question. All right. Is 14% IRR represent only upon selling the property, or does the investor get yearly 14% IRR?
Yeah, so I have to be careful answering this question, right? Because it was really important to understand the definition of IRR. It's going to look at the discounted cash flow, right? To get the discounted cash flow to equal to zero. So what's really important is to understand that if I could double your money, um, if I double your money in a month, your IRR is ridiculously high, right? If I double your money and it takes me 100 years to do it, it's going to be, I still have the same outcome, and I still produce the same return on investment ROI, but I've really, really hurt the IRR. And so the reason I'm saying I have to be careful answering this question is because if you're providing cash flow to investors and you're paying them out each month, that's different IRR. That's a different expectation, and you can expect different IRR results than somebody who doesn't have that in their operating agreement, right? And that's not a part of the expectation that they're setting, that they're going to be sending you monthly or maybe quarterly cash flows. If that's not the expectation, that's going to impact the IRR as well. So it's hard to put a pin there. I would say that we target high teens for our IRRs. and that's going to be affected by the whole period as well. So sorry I didn't give a black and white answer, but that's what I feel about that.
I think that's a great answer and a great clarification of, yeah, if I give this to you over 1 year, 1 day versus 100 years, same rate, but getting them 1 day versus 100 years is quite the different situation. So I think that was a great clarifying answer. I don't see any more questions, but we are on the 1 o'clock hour. I have my favorite question to ask everybody that comes on, if that's okay. For anyone just brand new starting in the multifamily space, they're really new to this, they're kind of gathering their information, they're watching webinars like these. What would your golden nugget of advice be to them kind of just starting out in the multifamily syndication world of investing?
Yeah, I have two bits of advice. And they're different. They're different people, right? Because someone who wants to do the business, it's a little slightly different. Like you're gonna have to network. You're gonna have to get yourself educated because you're gonna be managing people's money, and it's a huge responsibility. So you want to make sure you're getting connected with people with integrity, so that you can put your name behind all that stuff. So that's like the general answer. There is getting connected, really getting yourself educated, so you can kind of sniff out the good and bad, right? So for potential operators, it's a slightly different path. But let's talk more about people interested in the asset class in general. Education, again, right? Really huge thing. Understanding the track record of your operators, wildly important, and making sure that they have repeatable results and that they've done this over and over again. That's what I would, really look at. And so my advice to you would be to start connecting with people. So I hope there's an investor at derosagroup.com that gets forwarded to me. My personal email is vceleste@derosagroup.com. Really encourage you to reach out. And let me just say this for every general partner. There's always usually someone like me, right? My whole job is I'm very happy to talk to you because that's what I'm here to do. So it's unlike any other thing I've experienced where I don't know. Sometimes I felt guilty, like stealing someone's time, right? You don't have to feel like that in this industry. People are very happy to talk to you about what they have going on and ask your questions away. And you'll get more questions as you learn more. And so absorb content, get connected with people. And I hope to hear from you guys soon.
Awesome. That was actually perfect. I love both of those answers. That's awesome. Well, thank you so much, sir, for being on the program today. We really appreciate it. That was some amazing information as we have more and more multifamily investors. We have one more question that we will let go because I think this is a good one. What investment class would this fall under? I'll answer this first as Quest. This would fall under private entities investment because you're investing as an LLC. But Vincent, what would you answer this as?
I wasn't sure at first if they meant because we sell different asset or share classes too, Class A and Class B. That's typical for a lot of general partners or operators. So I wasn't sure if that's what they meant about the 14%. But so sorry, I don't think I have any more clarification I could provide.
Yeah, so I guess as Derosa Group, you'll have two different share classes of funds, and as a class, as this is an investment, if you'd want to process this through your IRA, this is considered a private entity investment because you're actually investing with a private entity through like an LLC. You're not actually investing with a piece of real estate because in real estate, you're buying the whole thing. I've clarified the 5 classes. I'm not sure.
Is it?
Maybe the 5. Oh, I guess this would be in the real.
There's 5 here. It would be real estate, and it would be, what we're talking about today are large commercial multifamily properties in real estate.
Thank you for that.
By the way, I'm not a tax expert, so if this is like something to do with that, I'm sorry too.
No, I think it's perfect.
Yeah.
All right, guys. Well, thanks so much for joining us today. Thank you so much for joining us for our noon class. Thank you so much, Mr. Celeste, for joining us from Derosa Group and giving us so much new information on the multifamily world. Very good information there. I always learn so much and take notes for myself. So it's great to be here with y'all. Have a wonderful weekend, everybody. It was great to see you here. Make sure you're contacting us. Contact your IRA specialist. We are happy to help you get those accounts open, get you more information about our speakers, of course. Any more information you want on UBIT, on multifamily, on new accounts. We have QuestCon coming up. We have discount codes for you. We're happy to help you with that. So have a great weekend. We'll see you next Saturday, noon, same time, same place. And Tuesday's noon class will be on Roth conversions with Derek Long. So another exciting topic. Have a great weekend, everybody. See you next weekend. Bye, guys.
Thanks for